Good day everyone. I am Daicilyn P. Magsanoc, student of BSBA 1B. So the topic is about globalization. The term globalization refers to the increasing interdependence of the world's economies, cultures, and populations as a result of cross-border trade in goods and services, technology and flows of investment, people, and information. Over many centuries, countries have formed economic alliances to facilitate these movements. However, the term gained currency after the Cold War ended in the early 1990s as these cooperative arrangements shaped modern life. The term is used more narrowly in this guide to refer to international trade and some investment flows among advanced economies with a focus on the United States. Why is globalization important? Globalization's far-reaching consequences are complex and politically charged. Globalization, like major technological advances, benefits society as a whole while harming specific groups. Recognize the relative costs and benefits. Globalization alters the way nations, businesses, and individuals interact. It physically alters the nature of economic activity between nations by increasing trade, opening global supply chains, and providing access to natural resources and labor markets. Changing the way nations conduct trade, financial exchange, the interaction promotes cultural exchange. It removes the constraints imposed by geography, political boundaries, and political economies. For example, globalization enables businesses in one nation to access another nation's resources. More open access changes the way products are developed, supply chains are managed, and organizations communicate. Businesses find cheaper raw materials and parts, less expensive or more skilled labor, and more efficient ways to develop products. With fewer restrictions on trade, globalization creates opportunities to expand. Increased trade promotes international competition. This in turn spurs innovation and in some cases the exchange of ideas and know-how. In addition, people coming from other nations to do business and work bring with them their own cultures which influence and mix with other cultures. The many types of exchange that globalization facilitates can have positive and negative effects. For instance, the exchange of people and goods across borders can bring fresh ideas and help business. However, this movement can also heighten the spread of disease and promote ideas that might destabilize political economies. Types of globalization: economic, political, cultural. Economic globalization. Here, the focus is on the integration of international financial markets and the coordination of financial exchange. Free trade agreements such as the North American Free Trade Agreements and the Trans-Pacific Partnership are examples of economic globalization. Multinational corporations which operate in two or more countries play a large role in economic globalization. Political globalization. This type covers the national policies that bring countries together politically, economically, and culturally. Organizations such as NATO and the UN are part of the political globalization effort. Cultural globalization. These aspects of globalization focuses in a large part of technological and societal factors that are causing cultures to converge. These include increased ease of communications, the pervasiveness of social media, and access to faster and better transportation. Effects of globalization. The effects of globalization can be felt locally and globally, touching the lives of individuals as well as the broader society in the following ways. 1. Individuals. Here, a variety of international influences affect ordinary people. Globalization affects their access to goods, the prices they pay, and their ability to travel to or even more to other countries. 2. Communities. This level encompasses the impact of globalization on local or regional organizations, businesses, and economies. It affects who lives in communities, where they work, who they work for, their ability to move out of their community and into one in other country, among other things. Globalization also changes the way local cultures develop within communities. Number 3, institutions, multinational corporations. National governments and other organizations such as colleges and universities are all affected by their country's approach to the acceptance of globalization. Globalization affects the ability of companies how to grow and expand a university's ability to diversify and grow its student body and government's ability to pursue specific economic policies. While the effects of globalization can be observed, analyzing the net impact is more complex. Proponents often see specific result as positive and critics of globalization view the same result are negative. A relationship that benefits our entity may damage another, and whether globalization benefits the world at large remains a point of contention. The second topic is about role of international financial institutions in the creation of global economy. So, a financial institution or FI is a company engaged in the business of dealing with financial and monetary transactions such as deposits, loans, investments, and currency exchange. Financial institutions encompass a broad range of business operations within the financial services sectors including banks, trust companies, insurance companies, brokerage firms, and investment dealers. Virtually, everyone living in a developed economy has an ongoing or at least periodic need for the service of financial institutions. Understanding financial institutions or FIS, financial institutions serve most people in some way, as financial operations are a critical part of any economy, with individuals and companies relying on financial institutions for transactions and investing. The governments consider it imperative to oversee and regulate banks and financial institutions because they do play such an integral part in the economy. Historically, bankruptcies of financial institutions can create panic. In the United States, the Federal Deposit Insurance Corporation or FDIC insures regular deposit accounts for reassure individuals and businesses regarding the safety and their finances with financial institutions. The health of nations' banking system is a linchpin or economic stability. Loss of confidence in a financial institution can easily lead to a bank run. Types of financial institutions: commercial banks. A commercial bank is a type of financial institution that accepts deposits, offers checking account services, make businesses, personal and mortgage loans, and offers basic financial products like certificate of deposit or CDs and saving accounts to individuals and small businesses. A commercial bank is where most people do their banking as opposed to an investment bank. Banks and similar businesses entities such as thrips or credit unions offer the most commonly recognized and frequently used financial services: checking and savings accounts, home mortgage, and other types of loans for retail and commercial customers. Banks also act as payment agent via credit cards, wire transfers, and currency exchange. Investment banks. Investment banks specialize in providing services designed to facilitate businesses operations such as capital expenditure, financing, and equity offerings, including initial public offering or IPOs. They also commonly offer brokerage services for investors, acts as market makers for trading exchanges, and manage mergers, acquisitions, and other corporate restructuring. Insurance companies. Among the most familiar non-bank financial institutions are insurance companies. Providing insurance, whether for individuals or corporation, is one of the oldest financial services. protection of assets, and protection against financial risk. Secured through insurance products is an essential services that facilitates individual and corporate investment that fuel economic growth. Brokerage firms. Investment of companies and brokerages such as mutual fund and exchange-traded fund or ETF provider fidelity investments, specialize in providing investment services that include wealth management and financial advisory services. They also provide access to investment products that may range from stocks and bonds all the way to lesser-known alternative investment such as hedge funds and private equity investments. So why are financial institutions important? So financial institutions are important because they provide a marketplace for money and assets so that capital can be efficiently allocated to where it is most useful. For example, a bank takes in deposits from customers and lends the money to borrowers. Within the bank, as an intermediary, any one individual is unlikely to find a qualified borrower or know how to service the loan. Via the bank, the depositor is able to earn interest as a result. Likewise, investment banks find investors to market a company's shares or bonds to. For examples of financial institutions, in many parts of the world, international financial institutions or IFS play a major role in the social and economic development programs of nations with developing to transitional economies. This role includes advising on development projects, funding them, and assisting in their implementation. And that's all. Thank you.